The S&P 500 is down over 10% since March, with the likes of Morgan Stanley now saying that we could be entering a bear market. That would require the S&P 500 to fall by more than 20% from its most recent high. And while it's not quite there yet, that's not to say it won't happen. Then there's the commentary also from Morgan Stanley saying that stocks have been oversold by investors, meaning any good news could actually spark a bear market rally. All of this is happening against the backdrop of rising interest rates, supply chain disruptions, and conflict in Ukraine. Naturally, investors want to know whether more days like this are coming, and if so, why they're coming and what they should do about it. So in this video, we're going to discuss the current state of the stock market. We'll talk about all the factors affecting prices, as well as what the future could have in store, and most importantly, where your investments fit into that future. The three factors which are impacting the stock market the most right now are rising interest rates, the supply chain crisis, and the war in Ukraine. When Morgan Stanley talks about the potential for a bear market rally on the back of any good news, they're referring to good news in relation to any one of those three factors. The one thing that each of these factors has in common is that they all relate to inflation. Inflation has been a big problem for a while now, and it's something that we've talked a lot about on the channel. Eurozone inflation last month hit highs of 7.5%, while in the States, inflation numbers from March were the highest in over 40 years. Prices are getting out of control, which is something no central bank wants to see. So in response, the Federal Reserve in the United States and the European Central Bank in Europe are planning to increase interest rates. The Fed increased interest rates by 0.25% last month and has another 0.5% increase in store for May. Meanwhile, the ECB is expected to increase its rates later this year. The reason why central banks raise interest rates in times of inflation is to increase the cost of borrowing money, therefore limiting the supply of money in the economy, therefore reducing the demand for goods and services, and by proxy, reducing the pressure on prices. So why does the stock market care about interest rates rising? The price of every stock on the stock market is calculated as the present value of the market's expectations for future company cash flows. In other words, what the market expects the company to make in the future and the value of that expectation today. Investors use a valuation model known as a discounted cash flow or DCF model to try and figure out what the present value of those future cash flows is. The reason why we care about any of this is because when we invest in a company's stock, we become partial owners of that company. And so what the company earns in the future is what's going to drive returns on investment. But we have to recognize that money received in the future is worth less than money received today, because money received today can be invested. This is what's known as the time value of money. So to recognize the time value of money, we discount the cash flows which we expect the company to earn in the future in order to get the present value of those cash flows today. Generally speaking, investors will use the risk-free rate of return to discount the cash flows to the present value. This is known as the discount rate. The risk-free rate of return is seen as the return provided to investors by treasury bonds. The logic here is that an investor could choose to place their money into treasury bonds today instead of investing in the company's stock and get a guaranteed return on investment equal to the yield provided by treasury bonds at that time. So clearly, the yield offered by treasury bonds is going to impact the present value of future company cash flows. The higher the yield, the lower the present value. As we can see from the chart, yields on US treasury bonds have increased sharply since the beginning of March, when the Fed first increased interest rates. So when interest rates are rising, so too are bond yields, which lowers the present value of company cash flows, which in turn causes stock prices to fall. Rising interest rates also makes it more expensive for companies to borrow money, which in turn slows down business and reduces revenue and earnings. So what you have is this dual effect of potentially lower future earnings due to higher borrowing costs, combined with lower present values due to higher bond yields. This is why the stock market reacts so poorly to interest rates rising. And even though company revenues typically increase in times of inflation because they're charging higher prices to customers, so too are their costs. And it's hard to know whether revenues or costs will grow faster. This is especially true when we consider the supply chain crisis and the war in Ukraine. Global supply chains are still feeling the effects of the pandemic, with China's zero tolerance policies and strict lockdown procedures inciting delays. The latest research shows that over 200,000 US companies and over 118,000 EU companies have supply chain dependencies in Shanghai. Companies like Apple have warned investors that they could lose up to $8 billion in sales due to China's lockdown policies hindering supply. When you factor in the conflict in Ukraine and the impact that that's having on commodity prices and supply chain networks, you can start to see how big of a problem this really is. All of these factors are being taken account of by investors, and that's why the stock market is trending downwards. The other point to consider here is demand. The excessively high demand for goods by consumers throughout 2020 and 2021 is what caused the supply chain crisis. Yes, the pandemic and other factors caused bottlenecks in the system, but ultimately it was the high demand which lit the fuse. That demand came from unprecedented levels of monetary support from central banks, which gave everybody access to very cheap money. From a company perspective, high demand is a good thing because it means you can charge higher prices for your products, which is good for revenues. However, here's the issue. The market has gotten used to companies selling products in this high demand, high inflation environment. That has set a high expectation for earnings going forward, and many of the stocks which investors purchased in 2021 had that expectation factored into the price. But with central banks now increasing interest rates to reduce demand, company results are going to suffer, not only from lower revenues but also from higher costs. Another reason why stocks are falling. So, what do you do? Is it a case that the investments you made at the peak of the market were bad investments? How does one invest going forward if what the media says is true and things are only going to get worse? There's a simple answer, a slightly more complicated answer, and a caveat when it comes to answering these questions. The caveat is that every investment decision must be made in the context of your personal circumstances and your attitude towards and tolerance for risk. In plain English, you can watch videos on YouTube and read articles online, but at the end of the day, things like your age, your financial situation, and your short, medium, and long-term goals are far more important when deciding what to do with your money. Opinions from financial content creators, analysts, or anyone else are just supplementary. With that in mind, here's my simple answer. The vast majority of investors will be best served by investing consistently into low-cost exchange-traded funds, and to continue doing so for a long period of time. An exchange-traded fund, or ETF, is an investment product which allows you to get exposure to lots of different investments through one single investment. The key here is consistency. You're investing each and every month regardless of what the market is doing, investing at the highs, the lows, and everything in between. Essentially, you're not concerned with what the market is doing in the short term because you know what direction the market tends to go in the long term, and you're committed for the long term. If you ever need a reminder of why this makes sense, just open up the all-time chart for the S&P 500. As for the slightly more complicated answer, history tells us that certain types of investments perform better in times of inflation. Cash and bonds perform poorly and stocks do okay, whereas real estate and commodities steal the show away. And yes, that was some intentional rhyming. In all seriousness, having lots of cash sitting idle in a bank account is pretty much never a good idea. Never mind when inflation is running at 40-year highs like it is now. For example, if you had $10,000 sitting in your bank account for the last 22 years, it would have lost about 42% of its real value over that time period. But equally, it can be challenging as an investor to actually commit money to an investment when there's all this negativity and uncertainty surrounding the market, which is why my simple answer around ETFs is so important. But assuming you're looking for investment opportunities on top of ETF investing, I'd be looking at real estate investment trusts, value stocks generally, and any stocks which give exposure to commodities. Real estate investment trusts, or REITs, have been shown to outperform the market in times of inflation. REITs allow investors to gain exposure to real estate assets without having to own physical real estate themselves. Research from the National Association of REITs shows that total returns on REITs have outperformed the broader market in times of both moderate and high inflation. In fact, REIT dividends have outpaced inflation in 18 out of the last 20 years. So why exactly are REITs performing so well? Real estate prices and rental costs tend to increase alongside inflation, and this can translate into better financial performance for REITs. US REITs are legally required to pay out 90% of their earnings to shareholders as dividends each year. So the better financial performance of REITs associated with inflation supports a healthier REIT dividend for shareholders. Then we have value stocks, which have been found to outperform growth stocks in times of inflation. With value stocks, investors are looking for companies who are priced attractively relative to their financial performance, whereas with growth stocks, it's all about finding the big winners of tomorrow. Value stocks are normally represented by companies companies who are more mature in their life cycle, whereas growth stocks are normally companies in earlier stages. We can see from the graph that value stocks have significantly underperformed growth stocks since the Great Recession of 08-09. That's down to not only low inflation, but also an abundance of very cheap liquidity, which has propped up valuations for growth stocks. Now, however, as we are faced with a future marked by high inflation, rising rates, and potential recessions, value stocks will likely retake the throne. And that makes sense, because growth stocks have much less maneuverability, given that so much of their value is dependent on future results, whereas value stocks have more of an ability to adapt to and overcome challenging times. As for commodity stocks, we recently saw Warren Buffett and Berkshire Hathaway make a huge bet on Chevron stock, expanding their holding to become the third largest position in their portfolio, ahead of Coca-Cola. It's pretty clear that Buffett doesn't see oil prices coming down anytime soon, and is effectively making a bet that the supply chain crisis is here for the foreseeable. Now, that's not to say that you should go running out buying oil stocks, especially after the run-up they've seen in recent months. But history has shown that both industrial commodities like oil and monetary commodities like gold have performed well in times of inflation. So there is a case to be made for investing in companies which give you exposure to commodities. If I was to come up with one takeaway from the current state of the stock market, it will be the importance of smart investing decisions. If your portfolio is down by large double-digit percentages and you're somehow surprised as to how that happened, it's very likely you don't fully understand what you're investing in. And I'm not trying to pick on growth stocks, but far too many people put money into companies which are backed by hype without fully understanding the business model of the company or how reasonable or unreasonable the price of the stock actually is. And the lesson here is that most people probably shouldn't invest in individual stocks, because most people have no interest in putting in the time required to appropriately research a company, and that's totally fine. In fact, there's a perfect solution: low cost ETF investments consistently over many decades. Let me know what your thoughts are on the current state of the stock market and what your investment plan is going forward. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like in the video, subscribe to the channel, and I'll see you in the next one. Cheers.